We have a stock market crash warning from one of the most respected economists in the world. While the man who sued Apple in 2013 to make them pay dividend is saying that we are in a bubble that already burst and that the worst is yet to come. And to top it off, we had the worst week in the stock market since March. So should we be worried about our money? Well, let's find out. Let's start with the Nobel Prize winner Robert Shiller. This guy is not the average economist who predicts a crash every year hoping to get it right once and become famous overnight. No. This man actually invented many tools we use today to measure trends in the economy. And when he speaks, people listen. Mr. Shiller said last week that we're in a high-risk moment and that we should be careful. His conclusion is based on analyzing the stock market confidence indexes that he developed himself throughout the years. The first index that he mentions is the Crash Confidence Index. This measures the feeling that people have about the safety of the stock market, and the results are scary. It shows that the level of confidence in the stock market is as low as 15% for individual investors and 24% for institutional investors. In case you're wondering, institutional investors are the people who manage mutual funds and pension funds. It also indicates that an overwhelming majority of investors believe that there is a greater than 10% probability of an imminent crash like the one in 1929, the Great Depression. This clearly shows that people are anxious. The second index he talks about is the Valuation Confidence Index, which tells us the proportion of investors who thinks that the market is not too highly priced, meaning that they either believe that it is underpriced or fairly priced. The result? Only 38% of individual investors and 46% of institutional investors believe that, compared to 2009 when these numbers were respectively 77% and 82%. This tells us that not only investor confidence is low, but also stock valuations are quite high. In Shiller's opinion, this volatile combination, low confidence with high prices, shows that the risk of a stock market crash is relatively high. He then talks about the cyclically adjusted price-earnings ratio. This compares the stock market valuation from different periods. And guess what? This ratio was higher than it is today in only two periods, the 1920s just before the Great Depression and early 2000 just before the bursting of the dot-com bubble. However, in his opinion, these measurements on their own combined with a high stock price are not enough to cause a crash. What needs to happen is the creation of a psychological sense of risk. This could be the result of a further rise in coronavirus cases, like we've seen last week, or a chaotic or violent election, or any other event that could scare people. On the other hand, a peaceful election and a sense of a political and economic stability could have a calming effect. So right now we are on a crossroad and things could go either way. He then gives us some advice saying that no one knows the future, but given the general lack of investors' confidence due to the pandemic and political polarization, something negative could happen. This, according to him, highlights the importance of being well diversified, including treasury securities, which are bonds issued by the US government and are considered very safe. But he also advises not to go heavy on US stocks. I wonder how many people will actually follow this advice. The second warning we have comes from the hedge fund manager of Greenlight Capital, David Einhorn. This man sued Apple in 2013 to make them pay dividends, and he thinks that we are in a bubble and that bubbles tend to topple under their own weight. In the third quarter letter, he starts by saying that Greenlight Capital returned 5.9% in Q3 compared to 8.9% return of the S&P 500, meaning that his client could have made more money just by investing in an S&P 500 index. Not good. But then he comes with a quote from the Roman Emperor Marcus Aurelius, which goes like this: "The object of life is not to be on the side of the majority, but to escape finding oneself in the ranks of the insane." I guess that he's trying to say that he's done things differently and that it will pay off on the long run. He considers that we are in a dangerous situation with 34% of likely voters believing that a civil war is possible within the next 5 years. He also states that due to everything going on in American politics, parties are not able to find common ground on anything, and that political center is collapsing. He is referring here to centrism, which is the political philosophy of taking moderate position to avoid extreme. He believes that the only common ground between the two parties is the money printing. 3.3 trillion has been printed up to date. This represents 22% of all US dollars in existence at the end of 2019. That's a lot. He also says that even investors who argued against gold are now buying some. This is not surprising to him considering the instability we're in right now. He goes all in by claiming that we're in a huge tech bubble that he and his team discovered back in 2016, but at that time they thought that investors would not make the same mistakes like they've done in the 2000 tech bubble, but clearly they were wrong. He went even further and offered 10 reasons to why he believes we are in a tech bubble. Starting with number 1, what he calls the IPO mania. Despite everything going on, 2020 has seen a surge in initial public offerings, and the SPAC route was the preferred way to go public. Number 2, crazy valuation and new valuation metrics. Because traditional valuation methods would show that the stocks are overpriced, analysts found new ways to justify stock prices. In his opinion, this falls into the category of finding excuses for every behavior. Number 3, a massive market concentration in a few stocks in a single sector. Here he's spot on. The top 5 stocks in the S&P 500 make up 20% of the entire index. That's huge, because the S&P 500 is made up of 500 companies, and the technology sector represents more than 28% of the index. Number 4, the more fanciful and distant the narrative, the better the stock performs. I think that he's referring to stocks that had no revenue but still surged in valuation, like Nikola. It went public via SPAC earlier this year, and at its peak it became more valuable than Ford, even though they expected no sales until late 2021. And I have to agree with him on this one, guys. What happened with Nikola is crazy, right? I remember when I started following Tesla back in 2017, the press went bananas when Tesla's valuation overpassed Ford. But at least back then they were selling some Model S's and they revealed the Model 3. Nikola had nothing except promises, you know? How they managed to overpass Ford's valuation is still a mystery to me. Number 5, relatively unknown stocks with an S&P 500 type market cap. I'm not sure which company he's referring to here, maybe Nikola again, or perhaps Okta. The stock doubled in value year to date with a current market cap of around 28 billion. Few other cloud and software companies have seen similar growth, but again I'm not sure which one he's referring to exactly. Number 6, outperformance of companies suspected of fraud based on the belief that they will face no consequences. Initially I thought he's speaking about Nikola again, but then I realized that nobody believes that they would go unpunished if they were accused of fraud. The release of the Hindenburg report actually proved that, because after it came out the stock crashed, so it didn't make sense. So I dug a bit deeper and I concluded that maybe he's speaking about GSX Techedu. This is a Chinese technology-driven education company that provides online after-school tutoring services in China. It has been accused of fraud by many short sellers, allegedly exaggerating their profitability. Still, the market did not react the same way it reacted with Nikola, and the valuation kept going up, maybe on the belief that the Chinese company will not face consequences from the Chinese government. Again, this is just my opinion, I may be completely wrong. I'm just a guy on YouTube, alright? Number 7, an outsized reaction to an economically irrelevant stock split. Yeah, here at least it's straightforward, no guessing needed. He talks of course about Apple and Tesla. Both experienced a surge in share price. Tesla added more than 200 billion in market value in the 2 weeks after the stock split announcement. Still, I don't believe that the stock split was the only reason why the stock rallied so high. There are also the talks about Tesla joining the S&P 500, and let's not forget that they also smashed earnings estimate 3 or 4 quarters in a row. These are, in my opinion, only some of the factors that contributed to Tesla's today's market cap. The 8th reason for why we're in a bubble, according to Mr. Einhorn, is the increase of the participation of retail investors. In case you're wondering, retail investors is just a fancy word for individual investors like you and I. We are retail investors. And he's blaming us for joining the club and focusing on only big names when it comes to investing. I don't see why this would mean that we're in a bubble, really. The thing is that compared to the tech bubble back in 2000 or even 2009, individual investors did not have the same access that we have today. We didn't have Robinhood back then or Trading 212. Now you can buy stocks without paying any commission just by installing an app on your phone. You can even buy a small fraction of a share if you can't afford to buy the entire share, right? Meaning that the stock market is completely democratized today. Maybe this is why there are more of us investing out there. And I I know that we, individual investors, represent only 20% of the stock market activity. But maybe, just maybe, because of the excess of information, we contributed just a tiny bit, perhaps 2 to 3% to avoid the crash. Because anyone who watches on YouTube a video about the stock market will know that you should never follow your guts and sell on a dip, right? We even know that if the business model of the company that we are investing in is still good and viable, we should buy more at a lower price. What do you think is the percentage of individual investors who knew these informations back then in 2000 or 2009? I know someone who stopped his parents from selling all their assets at a loss because they were scared they will lose everything. This was back in March 2020 when the stock market fell massively. They were lucky because their son had some knowledge about the stock market, knowledge that he acquired online. If the same would have happened in 2000 or 2009, they would have probably sold everything at a loss like many other people did. Again, this is just my theory, I may be completely wrong, but let me know in the comment section what you think about this. The ninth reason he gave is the incredible trading volume in speculative instruments, like weekly call options. Yeah, I guess this one he's right, I have nothing to say about that. And number 10, a parabolic ascent to the top. Well, stock markets are at an all-time high, or at least they were before Friday last week, so let's see what happens this week, right? Here is something funny he said to prove his points even more. Apparently, Greenlight Capital received a job application from a 13-year-old who claims to be a good investor because he quadrupled his money since February. I don't know, guys, how strong this argument is, but it was clearly strong enough for him to put it in the Q3 letter. So who knows? He goes even further by claiming that the bubble actually popped on the 2nd of September and that as a result we will see a progressive shift in investors' mind from greed to panic, transitioning from a bull market to a bear market. He then explains what investment he made to tackle this bear market that he's expecting. I will link the full letter in the description if you want to see his investments. Okay, if you are watching this video, I presume that you've seen The Wolf of Wall Street. Do you remember in the movie what was the #1 rule of Wall Street? Nobody knows if a stock is going up, down, sideways or in bloody circles. Do you remember? And that's so true. No one has a clue. But I can tell you this one thing. The stock market always bounces back. Because if it doesn't, if the stock market will keep going down and down and down and down and will never recover and everything will go to zero, in that scenario it's not your money that is at risk anymore, but our civilization as a whole. This is why I am not selling any of my shares or investments, and in fact, if things get worse, I will buy even more, because I really don't believe that 1 year from now I will say, oh my god, I wish I didn't bought where prices were so low. I really don't believe that. However, remember this last thing. If you are new here, make sure to subscribe and hit the bell button. Thank you guys for watching and I see you next time.